afternoon, ladies and gentlemen, and welcome to another session of Unlock the Stock with CA&S Group. Unlock the Stock is specifically formulated for retail investors to gain access to corporate management and to get to know them and their companies just a little bit better. The event is sponsored by Keyter Insurance and FX, an FX intermediary and insurance brokerage for niche markets, which includes bloodstock, sport horse and game insurance, as well as household, vehicle, and commercial insurance. Whether it's in the insurance business or FX, Keyter are involved in matters that affect people's lives. Keyter Insurance and FX, in your corner. You can visit their website at www.keyter.co.za to meet the team and to read more about their services. The platform would not be possible without our technology partner, Lumi Global. Their website is lumiglobal.com, and you can visit it to find out more about the various integrated online AGM and investor presentation solutions that they offer. Our hosts, as usual, will be the Finance Ghost and Mark Tobin of Coffee Microcaps, and they'll be facilitating the Q&A session at the end of the presentation. We would like to welcome the CEO of CA&S, Duncan Lewis, who will take us through the presentation, and the CEO, Frans Rech, who will be there to answer questions. Before we commence, there are a couple of housekeeping rules. CA&S will do a short presentation. You will only be allowed to post questions in the chat box, which is at the bottom of your screen. So please do take advantage of that so that we can get some good conversation going. This event is being recorded and will be available on the Keyter Rech Investor Solutions YouTube channel, so be sure to subscribe to the channel. During the Q&A session, you will see an email address, and if you would like to be put onto the CA&S contact database, please take note of that email address. I'm now going to hand you over to Duncan, who will take you through the presentation. Duncan, can you share your screen, please?
Good afternoon, everybody, and thanks, Vanessa, for that introduction. I think that firstly, my thanks to Unlock the Stock team. Thank you for giving us the opportunity to engage with your audience, and I look forward to our time together. So thank you very much. This is really just what I want to cover this afternoon, is who we are and what we do. Importantly, an update of our on our half-year results, and then give you an overview of the segmental, in other words, the financial contribution by geography, and then importantly, our journey to 2026 and our growth ambitions, and then we'll end with questions from the audience. Many of the audience are unfamiliar with the CA&S Group. So what I'd like to do is to share a video with you, which hopefully gives you some insight into our business and an overview of what we do. Over to the video.
Rooted in Africa, driven to deliver, expand brands, and enable growth. Introducing the CA&S Group. Sub-Saharan Africa is regarded as the world's fastest urbanizing region, with the productivity of urban centers playing a pivotal role in fighting poverty and sustaining economic growth. While outside of South Africa, informal retail continues to dominate, modern retail is expanding across the continent. Small grocery shops are developing into mini supermarkets with multiple checkout counters and a greater assortment of products. While remaining price conscious, shoppers are becoming more discerning in seeking quality, convenience, and value in their purchases. The CA&S Group is a collective of fully integrated FMCG service businesses that are driven to execute our clients' brand distribution and growth strategies on the ground. We ensure brands get into hands by being as widely available, accessible, and visible as possible. With operations in 8 sub-Saharan African countries, the group offers specialist services in 5 key areas: warehousing and distribution, sales and merchandising, retail support services, technology and data, and strategic retail advisory and training. The group has an unmatched distribution network in the region, with companies closely collaborating to take brands beyond borders. World-class storage facilities and developed networks enable us to consistently deliver for our clients, giving them surety their products are safely warehoused and readily available. We partner with clients to grow their brands by increasing their market share through driving availability and volumes from the formalized trade right through to the main market via our cash van operations. We build on-shelf availability and visibility, optimizing brand positioning in category flows and ensuring sufficient stock is on hand and readily available. We assist in the maintenance of retailer systems and influence sales wherever possible. We have both deep in-country and local channel knowledge with well-established, respectful trader relationships across levels. These include retail, wholesale, pharmacy, and specialist outlets, as well as in the hospitality trade. The group runs shopper marketing campaigns and activates brands in every country with energetic, motivated, and trained brand ambassadors who are immersed in clients' brands to ensure they can educate and sell their benefits. Technically skilled, specialist point-of-sale teams build everything from cardboard and ad hoc displays to permanent customized runs and branded fixtures in steel, glass, and wood. We have decades of learning in the Salesforce automation space with mobile solutions that encompass everything from sales and invoice generation to stock and data management, business-to-business transactions, consumer loyalty and rewards, and integrated mobile payments. Technology services include image recognition technology and retailer data management and mining. A consultancy group business of seasoned industry leaders with both manufacturer and retailer career experience assists clients to develop end-to-end route-to-market strategies to unlock brand and business potential. We can assist with key account management, category plans, data analytics, capability training, as well as regional and global expansion support. Each of the businesses in the group were started by owner-operators focused single-mindedly around delivering on their clients' needs in a market they have deep local knowledge of and experience in. Markets that are not without their unique challenges. Individually strong, a group platform enables this strength to be leveraged across geographies. Solutions, process improvements, best practice thinking, and technologies are benchmarked, distilled, and shared between the businesses for increased effectiveness and efficiency. While we are focused on delivering today, the group is working to ensure we evolve as future-fit partners in Africa. As the landscape changes shape and the global pandemic impacts supply chain strategies and shopping habits, normalcy is no longer. We believe in real mutualistic partnership. Partnership that is symbiotic and generative of growth and opportunity for our clients, our people, our communities, and all of our stakeholders. Partnership that delivers impact and inspires hope.
So, I think just to expand on who we are and what we do, we talk about our business as being a holding entity of a group of services businesses that specialize in consumer packaged goods. But essentially, I think it's about essential services delivered by essential workers to ensure that millions of households get essential products they need to experience better quality lives. In simple terms, our job is to ensure what I would describe as on-shelf availability. Our clients pay us to ensure the products are in the right store at the right price at the right time so that shoppers and consumers can buy. We talk about being a purpose-led business, and specifically around the power of and. So we talk about saying, believing in the exponential power of true partnership to unlock the potential for our clients, for our people and the communities, for our business and the shareholders. I think that key to our success is, I guess, my partnership with the leadership in the respective organizations. These people are experts in the geographies, in the categories, and have been embedded in the business for a long time. They are highly entrepreneurial and future focused. I think the second thing is really around our partnership with the people that make up the organization. We employ 12,500 people across the group, and we're very deliberate around how we recruit people, how we induct them into the business, and how we invest in them and provide them opportunities to grow. And we find that this process of allowing them to become the best version of themselves that they can be creates an emotional bond with the business and the brands that we represent. And we think that this combination of our relationship with the leadership and the people that make up the organization is key to our DNA and our future sustainability. We operate across Southern Africa and have ambitions of expanding beyond that. And in the respective geographies, we've got different cultures, different backgrounds, and different experiences. But I think that what binds us together are these guiding principles, is the strong value system. I have no intention of talking you through all of it, but I think that you heard me talk about, the power of partnerships with our people. The second is our attitude, and we place a lot of emphasis on our attitude around being entrepreneurial, because we believe that drives the right behavior. I think that, we are restless, we're future focused, and trying to understand how we can remain relevant for our customers and provide value. I think that the last one I want to talk about is probably what we refer to as distinguished delivery, which is essentially around providing operational excellence. So, I think that our business is built on three things essentially. One is capability building. That means the right people equipped with the right skills and technology to deliver the results we expect. And the results we expect is really around the operational excellence, and it boils down to availability in store, visibility in store, etc., etc. So if we've got capable people doing the right things, our accelerated growth ambitions, we believe will happen as a consequence of that. Thirdly, is really around our partnership with our brand owners. We talk about the CA&S Group, and the CA&S stands for collaboration, activation, and sales. And the important bit is around the collaboration with our clients, and that is the third element of what really we believe makes up our DNA. So, I think that key to the customer intimacy is this collaboration and providing them with the value they seek beyond, I guess, the price and the cost to serve. If we look at these brand owners, we're very fortunate that we probably represent the top 200 consumer brands in the world, and this is who makes up our client base. Just to provide some flavor, this is the overview of the geographies. And in the geographies, you'll see the respective businesses that we have in these geographies. We refer to 8 geographies on the slide here, and that is really for our walls, wheels, distribution, and in-store execution businesses. but on our mobile technology platform, we're in 17 African countries. This is an overview of our service offering. So we talk about warehousing and distribution, sales and merchandising, brand activation, and retail services. On the warehousing and distribution part, you can see the businesses that provide that service. But I think it's important to note the revenue contribution. About 80% of our revenue contribution comes from warehousing and distribution, 15% from sales and merchandising, and 5% from the brand activation and retail services. The brand activation and retail services are really complementary to the other two services, and for the most part, this is about, I guess, adding value to the existing customers, but it's this element of the business is where we are mining the insights and the data, and this is what's making us a better business overall. Moving on to the half-year results, I think that we talk about the highlights. So if you refer to revenue, we've had an increase of revenue in the 6 months to 4.3 billion, or a 20% increase. EBITDA, an increase of 39.4% to 262.3 million. Operating profit increase of 46.8% to 215 million. Headline earnings up 56% to 138.4 million. Headline earnings per share up 44% to 30 cents per share. And then lastly, net asset value up 11.8%. If I unpack this further and we refer specifically to the revenue growth, I think that the three primary drivers of the revenue growth was around new business. Secondly, was around trade restrictions, specifically in alcoholic beverages in 2 of the 8 geographies that were lifted. And the third element was around price increases, but to a much lesser extent. Those are the contributions to the revenue growth. If you look at the operating profit growth of 46.8%, I think that just what I want to highlight is the percentage. If you look at half year 21, 4.1%, and half year 22, an increase from 4.1 to 5%. The 44% increase in headline earnings per share, I think, is really as a result of all the major operations performing well, and I'll give more granular detail to that later on. If you look at the income statement, I think that we've spoken about the revenue. EBITDA up 39.4%, profit after tax up 51.7%. Headline earnings up 46.4%, and headline earnings per share up 44.2%. Moving on to the balance sheet, I think that there's just 2 things that I want to mention there, and that is the increase in IFRS 16, and that is by and large because of the warehouse expansion in our Namibian operation, and that was 118 million rand. And then late last year, we did an acquisition of a business in South Africa, and the increase in goodwill was 36 million. Those are the 2 big drivers there around non-current assets. On the current liabilities, I think the big increase is really around, was the increase in inventory by and large because of our expansion into Lesotho, Zambia, and also we invested strategically in stock in some geographies because of service level issues or delays at borders. I think the important part here is that we talk about working capital levels. I think that we've improved our days receivable from 53 days to 50. Inventory we reduced from 34 days to 30. And creditors from 41 days down to 37. And then net working capital down to 43 days. I think that just moving on to the cash flow, I think that there's an increase in the tax paid. That's a result of our increased profitability, as well as the increase in provisional tax paid. I think the net interest included the IFRS 16 payment I referred to earlier. And then the net capex was really just we bought new trucks in certain geographies for the expansion and replacement of fleet in Lesotho, Botswana, and Zambia. If I move on to the segmental overview, and please forgive the busy slide, but you'll see the contribution by geography and the percentage growth. So if you take Botswana, revenue there for the half year, just under 2.3 billion, an increase of 16.3%. Eswatini, revenue of 658 million, increase of 22.5%. Namibia, 634 million, increase of 15%. I'm particularly pleased about the increase in Namibia. We really had very little warehouse space, and we couldn't take on new business. And so we made the decision to expand our facility, which we moved into in December last year. And I think that we've been rewarded as a consequence. South Africa, an increase in revenue of 29%. And all the other countries, in other words, Zimbabwe, Zambia, Lesotho, and the like, admittedly with a small base, an increase in revenue of just under 190%. I think the only thing I want to point out on the slide here is around the profit after tax that increased by 51.7%. Or in the previous year, the percentage was 2.7%, increasing to 3.4%. If you look at Botswana, these are the 7 businesses that we have in Botswana. I think that we're delighted with the result of geography. I think that the lifting of the alcohol ban has certainly contributed to the year-to-date result, which we're delighted about. I think on the downside is that we've had massive fuel increases, and on a year-to-date basis, the fuel price in Botswana has just about doubled. So we're trying to manage our way through that. But all in all, a pleasing performance from this geography. If you take Eswatini, also formerly Swaziland, both our liquor distribution business, which is SNC Brands, and just that you're aware of it, is that they do Heineken's business in country. They do Diageo, amongst others, for example, like Edward Snell, Jägermeister, and the like, have had a really, really good performance, as well as Logico, which is our grocery distribution that does ambient, chilled, and frozen distribution. And I think we're delighted with the result there. We take South Africa, Pack and Stack is our in-store execution business. So just to be clear, in South Africa, we don't do walls and wheels and distribution. We only do in-store execution. And that is by and large through Pack and Stack and effective sales and merchandising. Nice growth coming out of that. If you heard me say 29%, got a robust new business pipeline, took on the Premier Brands business, the Clover business, and we're delighted with what's happening there. Namibia, I think that you heard me talk about the increase in revenue growth of 15%. I think that we have lots of runway for expansion in Namibia. We're very pleased with what's happening there. And so you heard me say that we moved into our new facility in December. Now that we have the physical warehouse space available, we can now, get traction on our new business pipeline. I think that if you take all the other geographies that I spoke about, Lesotho, Zimbabwe, Zambia, We certainly see both Zambia and Lesotho continuing expanding in those geographies. We've expanded into distribution in Lesotho with SMC brands. We'll expand into Lesotho with our grocery distribution business this year, and doing exactly the same in Zambia, expanding our operation in Zambia with existing clients. I think importantly is just want to talk about our journey towards 2026. So I guess, if you look at year ending December 21, we did a revenue of 8 billion. You see that on a year-to-date basis, our revenues increased by, by 20%. Our dream, our ambition, I guess, if you like, is to be a 20 billion rand business by 2026. I think that whilst we talk about revenue growth, I think it's really a proxy for sustainable, profitable growth. So we're certainly not looking at revenue as the only metric for success. Very focused on the other financial metrics, but the point is that we're uncomfortable and we are future focused and working hard to deliver on the 20 billion rand dream. If you look at our journey from 2013 to 2018, we experienced a compound annual growth rate of 23%. I guess, history is not a predictor of the future, but our intention is to continue this compound annual growth rate of above 20%. And by doing so, we'll achieve the 20 billion that we've seeked out to do. If I just unpack that further, if you look at the slide, I think that our plan is to deliver on our organic growth ambitions, we believe will take us to 18 billion by 2026. And the difference between the 18 and the 20 is around acquisitive growth. And the acquisitive growth will be in strategic areas, whether it's strategic geographies, channel broadening, or other services potentially. I think that we believe that we're on track to achieve our 20 billion rand goal. It's certainly not going to be easy. I think that some businesses will exceed expectations, others will make it, and others will fall short. But our intention is to be nimble and navigate the short term, ensure that we continue to be focused on delivering this dream. This is really the building blocks to achieving the 20 billion. You heard me talk about channel broadening, new geographies, etc., etc. I think that these are the levers that we are going to pull to help us achieve that growth ambition. I think in closing, I think these are the individual elements that make up our organization or make up the capability of the organization. My personal view is that if you look at what's happened in 2020 and 2021, they were massively disappointing and a setback. But I think that despite that, we have much to be grateful for. I think that we have weathered the storm better than most. And I think that our diverse categories and jurisdictions have been positive for us. So I think that I think our staff, clients deserve our thanks. And I want to thank Unlock the Stock and the audience for your interest in our business, and really appreciate your time. So Vanessa, over to you with regards to the questions, ma'am.
Thank you, Duncan. That was lovely. We're now going to go into the Q&A session, and as a reminder, please pop your questions into the chat function below. And I am now going to hand over to the finance ghost and to Mark Tobin. Thank you very much.
Thanks very much, Vanessa. Duncan, first question, if I may. There's quite a lot of brands within the whole group, which have been acquired, I guess, over time. Can you just give me the thinking about why they haven't all been rebranded CA&S? Like why the original brands stay as they are, rather than making one consolidated brand offering? Because that's a lot of brands printing all sorts of things to kind of manage, rather than just having one simple CA&S brand.
Yeah, Mark, thank you. I mean, I think it's a fair question, but I think that we were incorporated as a business in 2011, but the businesses go back 6 and 7 decades in these geographies. So if you talk about the I guess the heritage, the deep in-country roots, the equity lies with the individual businesses. I think that if we look forward to our journey towards 2026, I think that there is merit in consolidating services behind different brands, and it's a debate that we're having internally. But as I say, these businesses are well established in those geographies, and the equity lies there. And we need to make, I guess, a considered decision about what's best going forward.
Yeah. Ghost, do you want to jump in with one or two?
Thanks, Mark. Duncan, thank you so much. Welcome to the JSE, I guess. If I squint, I can kind of see in the background of your video there, I see something JSE branded on the wall. So I guess that's either a listing certificate or who knows. Is that what it is? Yeah, there we go. So
it's a listing certificate, so correct, yeah.
There we go. So you can kind of see the excitement among the attendees that, there's a new name on the JSE, which is obviously exciting. My first question is kind of linked to that. So obviously this is, a legacy PSG thing as much as anything else. You're standing on your own feet now. You've got this very ambitious sort of growth strategy. A 20% CAGR is not to be sneezed at. That's a serious ambition, which is fantastic to see. I think in the slide, you made it quite clear, some of that is going to have to be through acquisition. So obviously as a listed company, lots of listed companies are kind of just sitting on their hands. They come to market and they kind of get stuck. That's not the sense I get with you at all. And I guess the question is, in terms of, those acquisitions going forward, how do you think about funding them? Do you think this is something you can do off internally generated funding from your profitability over the next few years? Is it something where you might tap the market for capital? Is it, obviously, it's not something you can commit to now, clearly, but just interesting to understand the strategy. Are you going to be one of those listed companies who really taps the market, or is it going to be more of a liquidity and share trading strategy, as part of being listed?
Yeah, and I think that, one of the primary reasons for listing was to address the issue of liquidity, but also to get, on a bigger stage. And, I think that with regards to going to the market, I think that if you look at our journey, between now and 2026, a large part of it is organic growth. We believe that for the most part, we can fund our organic growth strategy. I think that we have enough dry powder to fund that. However, there are potential opportunities that will require us to go to the market. So I think there's a particular size transaction where we will go to the market and try and raise capital. So I think that if you look at the journey between now and the end of 2023, I think that we'll fund all our own growth. Beyond that, we may need to go to the market. It's all about the size.
Duncan, another one from the audience here, and it's kind of linked to something I saw through the presentation. The margins in each country tend to kind of vary a lot, but when you get to the kind of company level, it kind of evens out at a kind of a fairly stable number. So my first question is, why does it vary so much at the underlying markets, whether that's Botswana versus South Africa, for example? And then the scope to grow that GP margin, is it economies of scale from going from the 10 to 20, or is it trying to drive more high value services, which I'm guessing the brand activations and the kind of retail analytics business is probably a bit more of a higher margin business than the pure warehousing and distribution business?
Yeah, so I mean, I think that the services differ by geography. So most notably would be South Africa versus Botswana. So in South Africa, we only have an in-store execution model, whereas in Botswana, we would describe it as a full service offering. We would do the walls, wheels distribution and in-store execution. So, that is a major contributor to the difference in margin. But also, if you take the difference in geographies, so if you take Swaziland, for example, and Namibia, the geographies are enormous in Namibia versus, by comparison, Swaziland, and that impacts the margin. So I think it's got to do with services, geography, and then product mix, because we don't necessarily do all the products in all the geographies. So I hope that answers your question, Mark.
Yeah, cheers.
Duncan, one that I've received is, why would brands choose to consolidate their distribution through you, for example, as opposed to setting up their own supply chain and providing their goods to wholesale, retail outlets directly? So maybe just a bit of understanding around the business model. What drives ultimately those, FMCG businesses to actually consolidate through you?
Yeah, I think that the full services offerings, walls, wheels, and distribution. So, I think that we have the benefit of economies of scale, where we are leveraging our infrastructure to service multiple retailers. So, I think that that is a significant contributor. But also, I think that, our expertise is not simply around warehousing and trucks, although those are obviously important that we do that well and that we're efficient in that space. It's also the IP. It's also about providing brand owners with route to market solutions where they get advice around how to win in these markets. So, as I said, is that we've been in these geographies for a long time. Our average client has been with us for at least 14 years. Some of our clients go back 5 and 6 decades. We are absolute experts in those categories, and we know how to advise our clients how to win, and we know how to implement those strategies in these markets. So I think that we have the expertise, but also we're able to deliver effectively and efficiently. Bearing in mind is that we've got world-class brand owners, we've got world-class retailers, and I think that as a consequence, we need to be fairly good at what we do in order to remain in business.
And that's kind of a corollary to a question I had, was around what's your moat, and I think you've kind of summed it up there, where for somebody to try and do this would be difficult themselves, and a lot of these relationships, as you say, going back 6 or 7 decades, that's very hard to replicate straight off the bat for a new competitor. But going into that, I just wanted to dive into, we've had a few questions around customer concentration. I know you had the slide up there, and there was a plethora of FMCG brands, from Adcock Ingram on the South Africa side to Kellogg's to Unilever. In terms of if we look at it across the group, I appreciate Botswana is roughly half of the business, or maybe a little more. Where does it land in terms of who the kind of top 3 customers are, and kind of what do they represent of like total revenue?
Yeah, I think that our top 15 brand owners probably give us 80% of our revenue. But I think that the categories, Mark, we don't only do what I would describe as grocery. We do obviously snacking and treating. We do personal care, home care. We've got a fairly broad range of categories we service. From high-end facial products to staples. So I think that mix serves us well. But 15 customers probably give us 80% of our revenue.
You're not just in a single aisle in these spars and elsewhere. It's multiple product categories within a single store.
Correct. Yes, absolutely right.
Duncan, I've got a question that's kind of related to that. So in terms of the actual retailers that you supply, ultimately, I understand your customers are actually the brands, but the retailers you're supplying, are there any concentrations there that, for example, if you were supplying a big portion of the revenue went into game, I would be a little nervous right now. So I think there's a couple of questions that I've kind of received around, how much of it is going to Choppies in Botswana? How much of it is going to the big retailers here? I mean, obviously you can't give like detailed numbers, but I suppose, are there any major concentrations? Something like ShopRite must be big, but anything you can talk about on there, I think will just help people understand. And then when you're done with that, I've got one more question before I give it back to Mark.
Yeah, to give you some ideas that, we supply all the retailers, but we also supply all the retailers, all the wholesalers. We supply all the hotel, restaurants, etc., etc. So, I think that we probably service on a daily basis 35,000 retail stores across all the retail brands, across all the wholesalers, etc., etc. So, I think that we've got a fairly diverse range of customers. So, in terms of concentration, I think that there's not, whilst you have some big players, there's nothing there that is enough to keep me awake at night.
And then my follow-up question, see, I'm learning from these American analysts when I always read those US reports. You've always got to have a follow-up. I'm not going to ask you to add color to something though, because that'll just make me feel a bit ill. But the question is, all the retailers are very focused on private label strategies. They love it because it gets their margins up. It gets them to control what the customer's getting. I mean, we know the reasons why they love it. How does that impact your business, this push into private label?
Yeah, look, so I think in South Africa, probably private label or confined label probably makes up 20% of the basket. And, as shoppers and consumers come under pressure, you'll probably find more and more shoppers and consumers going that way. But I must say is that give the retailers credit, is that the quality of the confined label and their brands have increased significantly. Many of them are world class. So if you say, is that potentially a concern or a threat to our business? I think that it's important to note that many of our brand owners, in fact, manufacture private label or confined label. So, as a consequence, we would participate in that. But also, in some cases, we're providing services directly to the retailer for those services. In other words, the in-store execution bit or the distribution bit in some of the geographies. So we are participating in that element of it.
You mentioned, like the fuel price in Botswana, and then just the huge geographies in Namibia and small populations of moving stuff around the country. In terms of, and we are in this high inflationary environment, I mean, how can you give us a sense, does that work in terms of how inflation gets passed through the chain from the brand owners to the sticker price that, somebody's going to see on a spar shelf, and then how the increased fuel costs, how you pass that back up the chain to, to the brand owners, your customers?
Yeah, so I think that Mark, our model is, as a general rule, we are not making a margin on product. We are making a margin on the services we provide. So in theory, when the brand owner does a price increase with the retailer, our costs would be taken in consideration, and our increase in fuel price would be a contributing factor to the price increase, and we'll be compensated as a consequence.
Yeah, that makes sense.
Okay.
I've received a question around just the earnings profiles. So to what extent are the earnings skewed towards the second half of the year? So I guess the sort of typical retailer kind of seasonality in a given year.
Yeah, I mean, I'm always nervous about predicting the future, but the point is we do have a seasonality to our business, and the second half of the year, based on history, is always bigger than the first half. So we probably have a 40-60 split between the first half and the second half of the year.
I just want to go back, if we can, to the 2026 strategy, and you said that acquisitions are going to be some form of that mix. There could be small bolt-on ones. It could be a larger one. It just depends what opportunity set presents itself. But in terms of multiples, what do these private businesses generally trade at? Whether it's somebody buying one to enhance the size of their business on the private side, or you looking to take a private business and fold it into the CA&S business?
Yeah, I think that again, just based on my previous experiences, Mark, and acquisitions we've done, the PEs vary between 4 and say 6. I think that good businesses cost money, and I think that you could potentially find yourself having to pay more than that. But based on history, multiples between 4 and 6 is what we've paid in the past.
Okay, perfect.
Duncan, a question around your dividend policy going forward. How do you think about that? And that's going to be quite interesting in the context of obviously the sort of acquisition pipeline that you guys have in mind as well.
Absolutely. So we don't pay an interim dividend. So our dividend policy is to pay out 20% of headline earnings every year, and the timing of that is normally we finalize our results at the end of March, declare the dividend and pay it probably in April. So to answer your question, 20% of headline earnings.
And then another one from me, I'm just trying to find it here from the person who sent it in. Oh yes, here we go. It's on growth. They wanted to know what growth is left in your top 3 markets. I mean, 2.3 billion is, quite a sizable business for a market as small as Botswana. But then I appreciate it's a different operating model in South Africa, but 600 million, I mean, that to me seems like there's plenty of scope to, grow within the South African market if you can do 2.2 in Botswana.
Yeah, so are you asking me specifically about South Africa, Mark? I beg your pardon.
Yeah, South Africa, if we take the 3 biggest ones, South Africa, Botswana, I think was Namibia third on the list, I can't remember. So
if you take South Africa specifically, I think that my personal view is that there's lots of runway. We're in terms of revenue in South Africa, we would be considered the number 2 player, I think, in South Africa. And I think that if I look at what I would consider from a revenue point of view, a number 1 player, I'd say they're at least, probably 2 or 3 times the size of our South African operation. And that will give you some indication of what we believe the opportunity is. But, the opportunity is not only going after competitor stuff. I think it's about how we can participate in private label, confined label, how we can participate in online and e-commerce. So the channel broadening strategy. So I think that our South African operation, there's lots of runway. If you take our most mature market, if you like, Botswana, despite it being, over 50% of our revenue, we continue to invest there. We still think it is an invest to grow market. There are lots of opportunities in Botswana around other services, channel broadening, whether it is pharmacy, whether it is quick service restaurants, forecourts, etc. We think there's lots of opportunity. I think that, I think over time you'll probably see a more balanced contribution by geography, but Botswana specifically, we still see it as an invest to grow market.
Duncan, a question from me. So something in your numbers that really jumped out at me, and I know when people get a slide full of numbers, their eyes sometimes glaze over. But one thing I've definitely noticed in the market at the moment from a net working capital perspective. Balance sheets are growing and growing and growing, right? And it's inflation and it's supply chain challenges. And it's good news for the banks because they lend against these bigger balance sheets. Your net working capital stayed pretty much flat year on year, which I think is exceptional. I'm not sure that was actually highlighted enough, or if people understand how good that actually is. I mean, you've basically funded your receivables and your inventory using payables almost entirely. I mean, is that something that is embedded in your business model? You know, for the next few years, will your uptick in net working capital be relatively light, I suppose? I mean, obviously, again, it's always hard to try and commit to these things, but if that's the case, that is a very strong element, I think, to the business model. I mean, that does wonders in a discounted cash flow valuation, if anyone's ever built one of those.
Yeah, you know, I think that the CFO's version is it's all him, but the truth is that we're very focused around working capital management, and it's a journey we've been on, you know, since at least 2019, and you know, I think that we're very focused around debtors management. We're very focused, excuse me, around inventory management, and invested heavily in technology around inventory management systems, warehouse management systems, transport management systems, to make sure that on the one hand, we're improving our operational effectiveness, but also that we're mining efficiencies in the process. So, you know, as a rule of thumb, I'm very focused on around what is our revenue per head, what is our cost per head, what is our profit per head, benchmarking that across the regions. And I just think that our intention is just to become better every day. This continuous journey of being uncomfortable and making sure that we have this continuous improvement. We talk about the power of and, is that we have pockets of excellence in every business. It's about how do we replicate those pockets of excellence. So I don't think it's one answer, but I think it's a combination of those things that have contributed to, I guess, you know, the results that you see.
And Duncan, we're pushing up on time, but I want to squeeze one more question in, and it's you know, to do with two-part. One, expanding into other geographies.
Yes,
you know, is that into East Africa, given, you know, where your base business is now, you know, to just push a bit further north and, you know, attractive markets like, you know, Kenya, Tanzania, or is it, you know, going over somewhere into like West Africa where you've got like, you know, big countries, big markets, Ghana, Nigeria? And then as a follow-on or as a part of that is, you know, heard a lot of talk about this like Africa-wide trade deal, a lot of expensive lunches, but to me, it doesn't, from what I hear, it doesn't seem like it's impacting anybody on the ground as yet, despite it being in place, you know, 2 or 3 years at this point. But like in terms of getting down that red tape, moving stuff around through countries in Africa, still seems to be as difficult as ever from anything I hear from people based in logistics or, you know, are trying to export throughout the continent.
Yeah. So, you know, I think firstly, Mark, if I understood your question around geographical expansion, you know, in the context of our 2026 dream, East Africa is our focus. You know, I think that by and large, we have a client-led growth strategy. So it's about expanding into these other geographies where our clients have an appetite for us to provide services. And we've got plans in place to deliver on that. So certainly East Africa. You know, I think that, you know, West Africa, you know, is an attractive market, but I think that, you know, I think we got low-hanging fruit in East Africa by comparison, and that's where we're focusing our energy and efforts. You know, I think that, and you know, I think as a result of us being more focused, I think that we have a higher degree of being successful there. You know, moving on to the second part of the question, if I may, Mark, is really around what I think is probably around the, you know, the African Continental Free Trade Agreement, something along those lines.
Yeah.
You know, I think that if I look at what the objective and the ambitions are, certainly we would support that. Are you with me? But I don't see evidence of that being in place in our market. So, you know, I think it's as difficult as ever. I think we would certainly support it, but as I say, we don't see evidence of it on the ground.
Yeah. Well, hopefully, if it does actually start going into action, I mean, it should translate into a huge, kind of cost saving and tailwind to your business if it does actually materialize into underground nuts and bolts of moving goods around throughout the continent.
Absolutely, and also it will do away with any grey trade that may exist as well.
And we're just up on time, so I'm going to hand back to Vanessa just to wrap up for us. Vanessa.
Thank you so much, especially to everyone who participated in Unlock the Stock today, and also to Duncan and France for making their time available to support this retail investor platform. Thank you very much. We hope that you've enjoyed the events, and just as a reminder, you can watch the video on the Keyter Rech Investor Solutions YouTube channel. Please also note that next month we have quite an interesting lineup. On Tuesday, the 4th of October, we're going to be profiling Growth Point. And on the 20th of October, you can hear from Pan African Resources and Calgro M3. And that is it for today. Thank you very much and goodbye.
Thank you, Vanessa, and thanks to your audience. Bye-bye, everybody.
Thanks, Duncan. Thanks, Vanessa.